Hello there. Did you know that in 2026, a single number is set to change the future of your family business, potentially forever? We're not just talking about a small tweak here. We're talking about a massive shift in UK tax that's going to impact your profits, your paycheck, and your legacy. Getting through this new landscape isn't just about knowing the rules, it's about having a strategy. So today, we're going to walk you through the smartest moves you can make to get ready for what's coming.
Right then, let's start with that number you're looking at right now. £2.5 million. From April 2026, this number represents a brand new cliff edge. It's the new cap for getting 100% inheritance tax relief on your business or farm. You see, for generations, this relief was basically unlimited, which meant family businesses could be passed down whole. This change isn't just a bit of tinkering with the rules. It's genuinely one of the biggest shakeups to legacy planning for UK business owners in years, and you really need to be paying attention.
Now, before we get properly stuck in, it's really important you know where this guidance is coming from. Everything we're about to cover has been developed by the expert tax advisors over at My Tax Accountant. They are one of the UK's most trusted accounting firms, and they've taken all these complex changes and boiled them down into the clear, actionable stuff we're going to talk about today. So here's a quick look at what's on the cards. We'll kick off with the deadlines that you absolutely cannot afford to miss. Then we'll get into the nitty-gritty of taking profits out of your company, and we'll look at how to protect your legacy. After that, we'll see what's changing with your paycheck, cover your new reporting duties, and then, right at the end, we'll pull it all together with the smartest moves you can be making right now. First up, the deadline. I want you to think of April 2026 less as a date on the calendar and more as a pivotal moment where a whole bunch of major changes all hit at once. And these things are all connected, kind of like dominoes all lined up. So if you're preparing for one, you have to be thinking about the others, which is exactly why getting a head start is so crucial. Let's just map this out. The whole journey really started with some announcements back in autumn 2024. But the real action, the big day, is April 6th, 2026. On that single day, the dividend tax rate goes up, that new inheritance tax relief cap kicks in, and making tax digital starts for a lot of people. And it doesn't stop there. A year later, the net widens even further. So you see, this isn't just a few random changes, it's a really coordinated shift in how the UK tax system works. Okay, let's dive into our first key area, taking money out of your company. For as long as most of us can remember, the classic strategy has been that tax-efficient mix of a small salary and bigger dividends. But a dividend tax hike is coming, and it's about to make that a lot trickier. You'll definitely want to hear this part. Let's break this down then. From April 6th, 2026, the tax you pay on dividends is jumping up by a flat 2 percentage points. That's for both basic and higher rate taxpayers. The additional rate, that's staying the same, and so is that teeny tiny £500 tax-free allowance. Now, I know what you might be thinking. A 2% hike doesn't sound like the end of the world, but believe me, when you're taking out serious profits, it adds up fast. Let's say you take out $50,000 in dividends. Well, that's an extra grand that goes straight to HMRC instead of into your pocket. And this brings us to the big, time-sensitive question that thousands of business owners are asking right now. Does it actually make sense to take out extra dividends before the April 2026 deadline, just to lock in that lower rate? Well, the answer isn't a simple yes or no. Let's try and make this simple. The argument for doing it now is obvious, right? You pay tax at today's lower rate. But here's the catch. If you take out too much, you could accidentally push your total income for this tax year into a higher tax bracket. Imagine this. You take an extra dividend to save on that 2% rise, but in doing so, you push yourself from a basic rate taxpayer to a higher rate one. Suddenly, your tax-saving move has completely backfired and cost you way more. So the bottom line is this. You have to model it. You've got to work with an advisor and run the numbers before you even think about making a call. Now stay with me. This next point affects nearly every single family-run business or farm in the country. We're shifting our focus now from your immediate income to the really big picture, protecting your business legacy, your life's work. And there is a seismic shift happening with inheritance tax relief that you just cannot afford to ignore. So at the heart of all this are two reliefs: agricultural property relief, or APR, and business property relief, BPR. The simplest way to think about them is as a pass from the taxman. They've allowed families for years to hand their business or farm down to the next generation without getting slammed with a crippling 40% inheritance tax bill. For decades, they have been the absolute bedrock of succession planning in the UK. And this slide right here shows you exactly what that looks like. Before April 2026, as you can see, the value of assets that could get 100% relief was unlimited. A £10 million family business could pass on completely tax-free. But after April 2026, that 100% relief is capped at £2.5 million. And this is the bit that catches people out. Anything over that cap only gets 50% relief. So a family business worth, say, £4.5 million could now be facing a huge tax bill on that extra £2 million.
But here's where some smart planning really comes into play. The good news is that the new £2.5 million allowance can be transferred between spouses and civil partners. This means, with the right will and the right estate planning, a couple can combine their allowances, so together you could potentially pass on up to £5 million of your business assets completely free of inheritance tax. This is why reviewing your will and your entire succession plan before 2026 has to be an absolute priority. All right, let's talk about the money that actually hits your bank account each month. Your paycheck. For a few years now, the UK's been splitting into two different tax paths, and 2026 just makes that even clearer. It really is a tale of two systems now, one for Scotland and another one for the rest of the UK.
So here's where a lot of people get confused. For most of the UK, the key tax thresholds are basically frozen in time. So as your wages, hopefully, go up with inflation, more and more of your income gets pushed into higher tax bands. This is what people call fiscal drag. It's a stealth tax, really. Your pay goes up, but because the goalposts have it moved, the tax man takes a bigger slice. Scotland, meanwhile, is on a totally different path, with a more complex six-band system that just leads to different results for everyone. You only have to look at this comparison to see how different things are. Don't worry about memorizing the numbers, just look at the pattern. In Scotland, you start paying the higher rate of tax, that's 42%, at a much lower income level, just over £43,000. That compares to over £50,000 in the rest of the UK. The key takeaway is simple. Where you live in the UK now has a direct and pretty major impact on your actual take-home pay. That's not all, though. This next change is incredibly important, especially for all you self-employed people and landlords out there. We're moving from what you pay to how you report it. We're talking about the next huge phase of making tax digital. This is a fundamental change, and you need to be ready for it. Let's break this down into 4 simple steps. First, figure out if you're affected. If you're self-employed or a landlord with a gross income over 50 grand, then yes, you are. Second, you have to choose an HMRC approved accounting software. Your old spreadsheet isn't going to cut it anymore. Third, all of your records have to be digital. And fourth, this is the big one. Instead of one annual tax return, you'll be sending quarterly updates to HMRC. It's a complete shift to real-time tax reporting. Now, the deadlines depend on your income. The first wave, for those with a gross income over £50,000, kicks off in April 2026. Then, a year later, in April 2027, the rules get extended to everyone earning over £30,000. The direction of travel is crystal clear. Digital, frequent reporting is the future. My tip here is really simple. Get ahead of this. Start using the systems now and save yourself a massive headache later. Amidst all this extra complexity, there is actually a little bit of good news when it comes to admin. For years, loads of higher-earning parents have had to file a full self-assessment tax return just to pay back their child benefit. Well, from now on, you'll be able to choose to have this taken through your PAYE tax code instead, which should make life a lot simpler for thousands of families. Okay, we have covered a lot of ground there. Dividends, inheritance, income tax, digital reporting. So now let's bring it all together. What are the smartest, most urgent things you should be thinking about doing right now? Here are my top 3. First, act on your dividends. Sit down with your advisor and properly model whether bringing dividends forward before that April 2026 rate rise makes sense for you. Second, protect your legacy. That $2.5 million IHT cap is a game changer. You absolutely have to reevaluate your will and your succession plan to make sure you're using every relief you can, especially that spousal transfer. And third, go digital early. If you're a landlord or self-employed, don't wait. Start keeping digital records today. It will make the switch to MTD so much smoother.
Right, just a very quick and important disclaimer. The information we've gone through today is for general guidance only. It does not count as financial advice. Tax laws are incredibly complex and they are always subject to change, so please always consult a qualified professional before you make any financial decisions.
And speaking of which, if you do want personalized advice from the experts who put all this analysis together, then get in touch with my tax accountant. Their details are right there on the screen. They can help you navigate all these changes and build a really solid plan for 2026 and beyond. And please do subscribe to the My Tax Accountant YouTube channel for more updates just like this. Thank you so much for watching.